Hi. Many people don't like taxes. It feels unfair when you earn little money but still pay a lot, while some rich people even say in public that they pay almost nothing. You may ask, how can they say that? Isn't not paying taxes against the law? And why doesn't the government stop them? We even hear about people and companies getting in trouble for not paying taxes. So what's the difference? Well, rich people have clever tricks to pay less, or sometimes no taxes at all. There are two main ways to avoid paying taxes: tax evasion and tax avoidance. Section 1. Tax evasion. Tax evasion is when someone breaks the law to avoid paying taxes. They hide money or lie about how much they earn so the government can't take the right amount. That's illegal and can cause big trouble, fines, or even jail. Example 1. Hiding the real price. One trick is to tell the government you made less money than you really did. For example, Alex buys a house from Adam for $500,000. With a tax rate of 10%, they should pay $50,000 in taxes. But to save money, Alex and Adam lie. They still exchange $500,000, but they tell the government the house sold for only $300,000. That way, they pay only $30,000 instead of $50,000, saving $20,000. This is illegal because they're lying about the real price to avoid paying the full tax. Example 2. Hiding assets. Another trick is hiding money so the government can't find it. In the past, Switzerland was famous as a tax haven. A tax haven is a country with very low taxes and strong privacy rules, which made it easy for rich people to hide money there. Normally, banks must tell the government how much money people have so the right taxes can be collected. But Swiss banks kept secrets and didn't share account details with other countries. So, if a rich person put money in a Swiss bank, their own government wouldn't know about it. This is illegal because they are lying about where their money is and not reporting it. Today, things are different. Many countries now force Switzerland to share account information. If, for example, an American hides money in a Swiss bank today, the bank will report it to the IRS, and that person could be arrested. Example 3. False deductions. False deductions happen when people lie about how much they spend so they pay less tax. Example: Sarah owns a pizza shop and earns $150,000. The government lets her spend money on her business before paying tax. If Sarah honestly spends $50,000 on renovations, she only pays tax on $100,000. That means her tax is $20,000. Altogether, she spends $70,000 and keeps $80,000. But if she lies and says she spent $50,000 when she really spent just $5,000, the tax is still $20,000. Her total spending is only $25,000, so she ends up keeping $125,000. Lying about expenses to pay less tax is illegal and can get you in big trouble. Section 2. Tax avoidance. Tax avoidance is all about using smart and legal ways to pay less tax. It's like finding little loopholes or taking advantage of deductions and credits that the law allows. Unlike tax evasion, which can get you fined or even sent to jail, tax avoidance is just clever money planning. So instead of breaking the law, you're simply using the rules to keep more of your money. Let's look at how tax avoidance works with some examples. The first trick is using something called controlled foreign corporations, or CFCs. A CFC is a company set up in another country where taxes are very low or even zero, what we call a tax haven. People can move their profits to this company to avoid paying high taxes in their own country. A real-life example is Apple, the company that makes iPhones and other electronics. Between 2009 and 2012, Apple avoided paying about $44 billion in taxes by setting up shell companies. One of the first was called Apple Corporation Euro in Ireland. It didn't have any employees, but it helped Apple a lot. Here's how it worked. Ireland decides a company's tax based on where its management is controlled. The US decides based on where the company is incorporated. Apple used this difference. By setting up a company in Ireland but keeping management control in the US, they avoided paying high taxes in both countries. Example 2. Transfer pricing. Transfer pricing is when a company moves money between its branches in different countries. They set prices for products or services so that more profit shows up in countries with low taxes. Simple example. Imagine a toy company has a factory in country A, high tax, and a store in country B, low tax. The factory sells toys to the store at a very low price. That way, most profit shows up in country B, where taxes are low and the company pays less tax overall. Example 3. Using dividends. Some rich people, like Warren Buffett, pay less tax than regular workers. That's because most of their income comes from dividends or long-term investments, not a salary. Dividends are taxed at a lower rate. Simple example. If you earn $100,000 as a salary, you might pay about 22 to 24% in taxes. But if you earn $100,000 from dividends or long-term investments, you only pay about 15%. This is a legal way to pay less tax. Summary. Tax evasion versus tax avoidance. Tax evasion is illegal. It's when people lie or hide money to pay less tax. Tax avoidance is legal. It's using smart strategies to reduce your taxes. Tax evasion is risky, but tax avoidance is a safe and clever way to manage money. If you want me to make more videos about this, please like and subscribe. Thanks for watching.